Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Credit Scoring Models. Credit scoring models are integral tools within credit risk management, serving as the backbone for assessing the likelihood of a borrower defaulting on a loan. They quantitatively evaluate various factors to determine creditworthiness, thereby guiding lending decisions. Understanding these models is crucial for professionals aiming to manage credit risk effectively. Credit scoring models primarily function by analyzing historical data to predict future credit behavior. These models incorporate multiple variables, such as an individual's credit history, current debts, length of credit history, types of credit in use, and recent credit inquiries. The most common type of credit scoring model is the FICO score, developed by the Fair Isaac Corporation. FICO scores range from 300 to 850, with higher scores indicating lower risk. According to Fair Isaac Corporation, factors contributing to a FICO score include payment history, amounts owed, length of credit history, new credit, and credit mix. This systematic approach allows lenders to quantify risk and make informed decisions. Another widely used model is the Vantage score, created through a collaboration among the three major credit bureaus, Experian, Equifax, and TransUnion. The Vantage score ranges from 300 to 850 and emphasizes similar components as the FICO score, but with slight variations in weighting. For instance, the Vantage score model places more importance on the age and type of credit and less on recent credit behavior. These models, while different in formulation, serve the same purpose of risk assessment and mitigation. The development and refinement of credit scoring models have significantly evolved over the years, leveraging advancements in statistical methods and machine learning. Traditional models rely heavily on logistic regression, a statistical method that models the probability of a binary outcome, such as default or no default. This method is celebrated for its simplicity and interpretability. However, with the advent of big data and artificial intelligence, more sophisticated techniques like decision trees, random forests, and neural networks have been integrated into credit scoring. These methods can capture complex, nonlinear relationships between variables and improve predictive accuracy. The practical application of these models extends beyond individual lending decisions. They are pivotal in the broader context of portfolio management and regulatory compliance. Banks and financial institutions use credit scoring models to aggregate risk levels across their portfolios, ensuring they maintain adequate capital reserves as mandated by regulatory frameworks such as Basel III. This regulation emphasizes the importance of robust risk management practices, including the use of advanced credit scoring models to safeguard the financial system's stability. Despite their widespread use and importance, credit scoring models are not without limitations. One critical issue is model bias, which can arise from the data used to train these models. If historical data reflects existing biases, such as racial or socioeconomic discrimination, the model may perpetuate these biases, leading to unfair lending practices. Research by Bartley highlights that minority groups often face higher loan rejection rates and less favorable terms due to biased credit scoring models. Addressing this requires ongoing scrutiny and adjustments to ensure fairness and equity in lending. Moreover, credit scoring models must constantly adapt to changing economic conditions and consumer behaviors. The COVID-19 pandemic, for example, significantly impacted consumers' financial stability, challenging the reliability of traditional credit scores. Many individuals who previously had strong credit profiles faced sudden income loss and increased debt levels. This situation underscored the necessity for dynamic models that can swiftly incorporate new data and trends to maintain their predictive power. To enhance the accuracy and fairness of credit scoring models, researchers and practitioners are exploring alternative data sources. Traditional models predominantly rely on credit bureau data, but alternative data, such as utility payments, rental history, and even social media activity, can provide a more holistic view of an individual's creditworthiness. Studies suggest that incorporating alternative data can improve access to credit for underserved populations, offering a more inclusive approach to risk assessment. In practice, implementing and maintaining credit scoring models involves several steps. Initially, data collection and pre-processing are essential to ensure the quality and relevance of the input variables. This phase includes handling missing values, normalizing data, and addressing outliers. Subsequently, model selection and training involve choosing appropriate algorithms and fine-tuning parameters to optimize performance. Once trained, the model must undergo rigorous validation and testing to assess its accuracy and robustness. This process often involves splitting the data into training and testing sets and using cross-validation techniques to ensure the model generalizes well to new data. Post-deployment, continuous monitoring, and recalibration are crucial to maintaining the model's effectiveness. Changes in economic conditions, consumer behavior, or regulatory requirements necessitate periodic updates to the model. Performance metrics, such as the area under the receiver operating characteristic curve and confusion matrices, are commonly used to evaluate the model's predictive power and identify areas for improvement. Furthermore, transparency and explainability are vital, particularly in regulatory contexts where institutions must justify their lending decisions. In conclusion, credit scoring models are indispensable tools in credit risk management, enabling lenders to assess and mitigate risk effectively. These models, ranging from traditional FICO scores to advanced machine learning algorithms, provide a quantitative basis for lending decisions and portfolio management. However, they are not without challenges, including potential biases and the need for continuous adaptation to evolving conditions. By incorporating alternative data sources and maintaining rigorous validation and monitoring practices, financial institutions can enhance the accuracy, fairness, and reliability of credit scoring models, ultimately contributing to a more inclusive and stable financial system. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.